In this video, I want to be open, honest, transparent about my trading, that I've been struggling to start the month of April, struggling in the sense of finding quality setups, and struggling in the sense of my plans actually working out and my trades going to my target. So looking at this dashboard here in the statistics, this is the first 3 days of April. I'm going to show you the 4th of April because that was the last day that I traded this week, and I took 10 total trades. However, in the first 3 sessions, I took 9 total trades, and we could see I had a win rate of 33%. Now, out of these 3 trades that were winners, 2 of them were not actually winners, that if I didn't sell early, my stop losses would have been hit, and this would have been categorized as a losing trade. One of the trades did actually work. However, I protected myself and got out early, but we're going to break down each session. I'm going to show you every single trade that I took, and you can understand what I did right, what I did wrong, and not only what I need to improve on, but everybody watching this could gain a lesson or something out of it that you can improve in your own trading. To add on top of this, my average win to loss was a 1.5. This number on a minimum with all my trades should be at least 2 to 1. However, there's one thing that I want to highlight here is that despite having 9 trades and a 33% win rate, I want you to just keep an eye on my risk management. And some of these days, like I said, I did take some winning trades, but keep an eye on how small these losing trades are. It sucks losing. However, I'm very proud to say that I have a risk management system that works out for me, that protects me when I am wrong and protects me from going on tilt and completely destroying my account. So I take very much pride in how small my losers are compared to the winners, which you are going to see. So the first trade was on Monday. This was before the market opened in the pre-market session. I took a long position and I lost about a point on it on 10 full-sized E-mini contracts. It was a $600 losing trade. Now going here, what we're going to see here is on the S&P 500, I'll pull up my pre-market plan. I post these every single day in the Discord of the setups that I'm watching and the levels that I'm looking out for. And this is going to bring me to my first point, that I had such a large bias to the long side on Monday that bias completely clouded my judgment and enabled me to not go with the flows of the market instead of going with the flows of what's in my head on what I expected to happen or where I expected the market to go. So my biggest thing was on the pre-market plan, my scenario number 2 is if the market can open below 53.16, which is this pink box over here. If we can open below this and it breaks 53.10 support, I am interested in shorts targeting 5,300. So this was my bearish downside plan. Also for transparency, every single trade that I have taken has been posted and is posted in real time in my Discord community. So here we can see the long that I took in the overnight session. I was holding that support level. I was interested in taking it. I exited it for a 1-point loss. Now the second trade occurred at 9:33, 2 minutes after the market opened, where I tried to set up long again after the market bounced off of the 53.10 support level that we can see right here. The reason for this was the market was holding the overnight lows. We were holding the support level, and there was some really strong buying volume that came in. So with this, and when the market looked like this before the rally, I was comfortable getting long. Now, there were some volume patterns that occurred at 53.18, which was my target. Now, this was a mistake because my mistake was I was so biased that the market was going to hold this support level and rally up that I completely ignored the facts and I completely ignored the truth of the market. So this trade started working out in my favor. We started rallying, we broke the market high, and I completely ignored the supply zone. I was acting like it wasn't there. I was acting like the market was going to blow straight through it and we were going to rally up super strong. Now with this in mind, I saw the high of day breakout and then I saw the market failing and I exited this trade before my stop loss and before my target hit because I was scared to give up gains. This resulted in a $2,000 profit. Now we can't look at this as a profitable trade. Eventually the market keeps selling off, and this brings me into my next trade where I entered off of the same exact analysis. So here we can see the market break under the low of day, right? And I love low of day breaks where the selling is not as aggressive, right? So if you look at the time in sales and the market breaks a low, and you either see a lot of aggressive selling, but the market is not moving down, that's a good indication the market may want to move up. or if the market breaks the low and there's aggressive buyers buying under that low, it also indicates the market may want to move up. So here we can see the market break the low of day, and I get in another entry long. It was a 2-to-1 planned risk to reward ratio, so solid according to my minimum. And here's what it looks like. The market sells off, breaks the low. We start rallying back up above 53.10 support. So essentially the market breaks under the low of day and the pre-market low. And I'm saying, okay, there's some really strong buying here. I love seeing this. The market's reclaiming the old support level. Let me get in long, targeting the 53.18s. Again, completely ignoring the supply zone. Well, this idea completely flopped because the market eventually failed, kept selling off, and I get out of this trade early for a small loss. Now, one thing about me is how I trade and how I protect myself is how I'm entering the setups and how I'm confirming the trades and how I get my confirmation signals. Most of the time, 95% of my trades that do work out directly after I enter. So if I'm in a setup with how I'm confirming the trade and the market either consolidates there or holds or just moves sideways, I know really how I confirmed that setup didn't really validate the thesis. So in this example, my stop loss was 53.06, but I got out at 53.07, 1 point before my stop loss. Now, the only way I trade with this way is I always have in the back of my mind is after I stop out, I could simply just re-enter, even if the analysis or thesis is the same, if my confirmation is better. So here I got out 1 point before my stop loss, making it a smaller loss. However, I knew this setup was invalid because the market just hung out and then eventually found sellers to continue dumping the market down. Now, my last trade on Monday was the same exact thing, the same exact entry, the same exact analysis, everything was the same. The market breaks under the low. So here we can see the previous low. The market breaks under this low. We consolidate there, and then the market tries to move up. I get long on that move up, and then eventually the market starts selling off, and I get out prior to my stop loss hitting because I know how I confirmed this trade simply did not validate my thesis, and I may be incorrect on the timing. So this was a $300 losing trade, and what it looks like is here. You know, all three entries were the same. When I got long earlier, we bounced off of here. When I got long the second time or third time, it bounced there. When I got long the fourth time, it bounced here, right? They were all low of day fake out potentials, reclaiming above support, targeting the 53.18s level. But I was so blinded by this information that I completely ignored the fact that the market has rejected the supply. And if I were to go to my pre-market plan was more bearish if we reject the supply at 53.16 and open below the support level. So I was so blinded because I wanted the market to bounce that I completely ignored the best formation, which was how weak this move was, rejecting the supply and rejecting under the support level. So now Tuesday comes, April 2nd. My separate plan now was to look to take longs at 52.44, which was the demand zone of the green box down there, which was the downside shorts target. Now, about 23 minutes into the market being open, we sell off into this demand zone, and I take an entry long at 52.41 with a 3-point stop loss and a minimum 12-point reward. So this was a 4-to-1 risk to reward ratio. And this trade was a $900 losing trade, and I get out 2 points before my stop loss. Now, I have a rule of thumb, so this is what the market looks like. And this was similar to the setups that I took the day prior, where the market's in a demand zone or at a support level. We break under the low. You could see really strong volume come in here. And even if I were to pull up the heat map and I show you what the tape looks like, here at 9:52, what you're going to see is here's the original low that the market forms. We're at 9:52 Eastern time. The market's going to break this low, right? And we're going to see a lot of aggressive selling with the bid getting filled. We see a volume tail indicating this move is getting rejected. Rejected meaning it's not being accepted to the downside, meaning the reversal to the upside is likely to come. And with this information, I'm comfortable getting long down here at the 52.41s with a stop loss 1 point under the low of day. I have a rule of thumb that if I am up on the S&P 7-10 point minimum, I never let that trade go red on me. Meaning if the market does move in my favor and I am correct on how I'm confirming it, but it fails to rally up or drop into my target, when I'm up 7 to 10 points, I never let that trade go red on me, or I look to exit for a break even or a small profitable trade or a small losing trade. So here the market rallies up and I'm up 9 points on the setup, 10 points on the setup, right? I'm up a decent amount. At one point I was up $7,000 profit on this trade. And somehow I let it turn into a $900 losing trade. Not really somehow, but the market dumped and I had to exit this trade because I knew if it comes back to my entry after I've confirmed this setup the way I've confirmed it, it should not occur like that based off of my data and based off of my testing. So I got out to protect myself, and that was a good move. Remember, always have the thought of re-entering. Same thing occurs like was on Monday. Now I took the next trade, was a $180 losing trade, and I got out 3 points before my original stop loss because the market moved up 7 points after my entry. So over here, here's my first exit. We'll be watching for a re-entry once I got out at the 40s. 1021, I'm trying it long again. The market similarly broke under the low of day, started to rally up, started to find weak sellers and strong buyers, and I was comfortable with a 3-point risk for a 15, 14-point reward, right? Like really, really good risk to reward ratios. As we can see here, the market was finding buyers. I was speculating the market would rally up higher off of the tape. And what this looks like off of the candlestick chart is right here. You know, the market breaks under the low, strong volume. We're seeing the same confirmations, but out of all the trades that I've taken so far, none of them have actually worked out, or if they did work out, they were failing to move to my target. Eventually, this thing rallies up 7 points. My 7 to 10 point rule is in effect. Then we just consolidate. Eventually, the market moves down, and I get out early, protecting myself. Now, this was my wrong move today, or this day. You know why? When the market is balanced or when the market is lacking volatility, I prefer not to scalp. However, I was going into the market with a scalping mentality. The market had made a very large move overnight. When the market has opened, it moved in a very tight range. So after a large move, it tends to be the market likes to hang out or consolidate and not make a larger move, but instead just move sideways to build liquidity. In this example, the market opened up after the large move overnight, right? I mean, you can see the really large move overnight. And now we're opening up and now we're just moving sideways. So I had the right analysis by taking the market long down here. However, I had the wrong execution because I was scalping non-volatile moves when in reality, I should be a little more positioned for the non-volatile moves. So eventually I stop out of this trade. Now, if I kept my original plan, because keep in mind, right? My original plan was stopping out at 52.36. So it was a 3-point risk, right? If I mark 52.36, it's down here. The market never hit my stop loss the rest of the session, right? And then eventually we get the rally up into my target that I wanted. 53s was my first target. So correct analysis, wrong execution, and wrong timing on these setups. So after I stopped out of that second trade, I tried it again when the market put in a higher low. And similarly, it rallied up and I stopped out of that trade prematurely. I was going for a scalping mentality, even though my analysis was correct. And my good buddy Dylan, who works for a prop firm in New York City, not an online prop firm, took the same trade as me. He made money on this setup and I lost money on it. The difference is I was scalping, he was more positioned. So that goes to show you could have the best analysis and the best levels, but if your execution lacks, that's going to separate a winner to a loser. So now the next trade was on Wednesday. This was a $2,200 profit. And again, it was a profitable trade, but I did some things wrong that I should not have done. Now keep in mind where my head's at, right? This is the start of Wednesday. It's a new day. I try to have a refreshed outlook on the market. I try to not bring what happened Monday into Tuesday into the session on Wednesday. New day happens, the market rallies up, and I take the market short. It's essentially my first short trade of the week off of this analysis. So pulling this up here, going to the Discord, what we're going to see is the market rallies up, and I see the market break the high with lacking buying volume, but it was also lacking selling volume. So I tried it short, reversing the rally at the 71s with a 2-point stop loss, targeting a 5-point drop to the downside. Right, my target was the 66s. Now the reason for all this was here the 66s, we could see some strong volume there prior to the continuation move up. So I knew that the market could gravitate towards there. Here's the high of daybreak, the market breaks the high, the buying gets weaker, a seller gets filled, and then the market dumps from that. So now I'm in short, this trade works out, we get to dump into my 66 target, and what I do is, and I don't know why I've done this, was I held runners. Number one, I'm going against the trend. I'm counter trend scalping it. Number two, the freight train's moving at me, and I didn't step out of the way. I stayed in front of the train, and essentially my runners. So I got out 75% of this trade at the 66s, which was my original target, right? 66 was my original target. Got out 75% of there to protect myself and held runners for a further drop. I was expecting the market to test the range prior to the news. We never get that, and I should not have held runners with this type of context, and I exited the runners essentially 1 point above my entry on the remainder 25% of that. Now, later in the session, we kept seeing the same thing. The market kept rallying up. The buyers seemed to be getting exhausted, watching for possible high of day failed breakouts. I'm not interested in longing a breakout. I am a seller on this rally with this information. So the whole day, I'm mainly focused on shorting the market and trying to reverse this move and capitalize on more downside. Now, an hour after the market opens up, I get short at the 75s with a 3-point stop loss, targeting a 9-point reward first, then a 17, 18-point reward after that. Here we could see, viewing it as the buyers getting weaker and weaker. Every single time the market breaks the high, the buying gets weaker. However, the thing we were lacking was sellers aggressively stepping in. So we saw the weakness from buyers, but we were lacking the aggressiveness from sellers. So what that looks like is here, right? This is when I get short. The market breaks the high, the buying is getting weaker. Eventually we just consolidate, and then it stops me out of this position, right? Now, as soon as this thing stops me out of this position, these 5280s was the high of day. And this was my second trade of the day. So I go here. The second trade was a $2,400 loss. So first trade was a $2,200 win, right? Second trade was a $2,400 loss. And this was correct analysis, wrong timing again, right? Shorted the market there, stopped out above the high, and then later in the session, guess what happened? The market absolutely dumped, and it was good market analysis, poor timing. So that was the start to the week. Yes, small loss, right? But yes, very frustrating that out of all my plans, maybe one of two of them actually worked out. And if I stuck with it, it would have went to my target. Versus the other 6 or 7 trades, none of them worked out and they were completely wrong on the analysis, right? So it gets mentally draining and mentally frustrating, you know, especially with just seeing everything that I'm doing essentially not working out. And it definitely will hit you hard and drains you emotionally and mentally. And the best advice that I could give is not letting that happen. Instead, just keep trading, keep focusing on your strategy, and keep looking for opportunity, because the next trade that you take could be the best one. So keep in mind, 33% win rate, 1.5 average win to loss trades. Now Thursday comes, everything starts turning, right? I take a really good setup, a $10,000 profit. Now, all you might see is green and, oh, the month turned around, right? And yes, it did. Now I'm green on the month. But this was a really bad setup, not in terms of I made money off of it, but in terms of how I executed it and what I did, because it was really only 6 points. I sized up. You see a $10,000 profit? That was because I did something that I've never done. If it went against me, I wouldn't be sitting here saying that my week turned around. Instead, I'd be saying I still continued to have a really bad week. So now my win rate went up 40%, and yet I'm green on the month. That goes to show you risk management is so important. And with this one trade, look at my average win-loss ratio. Now it's 3.5 to 1, right? So now everything's starting to switch despite this setup not being the best. The reason for this was, number one, I was sized up. And number two, I only got about 7 points on the E-minis. 7 points is really not a lot, especially if you're taking 5 or 6 trades where they're 2-point losses, 3-point losses. But because I was sized into this trade, it made the big difference. And the only reason I sized into this trade was because I did something a little differently. So essentially, my game plan was I was looking to long a drop. So we had old resistance at 52.95. Essentially, if the market could pull back and this level acts as support, I would be watching for me to play the market long at this level. Right? I was just, voicing out my opinion of what was going on. Cleaner moves were happening overnight. Then the market drops into the support level, and I try to long off of 52.97, targeting 53.11 to 53.18, which, if you remember, that was the same level from Monday in the week. So that was my essential main target there. The main objective was to get above 53.01. So that was at 10.29. So this is what the market looks like. And again, this is so similar to all the trades that I've been taking. We have our support level. The market sells off, breaks under the low of day, holds the support level after breaking under the low, bounces off of VWAP, and then begins to move up. What it looks like off the tape is this right here. So zooming in, here you can see the market have the low. We break under the low. We get back above that little bid that was sitting there. It reclaims back above that. And with that in mind, I'm like, all right, let me try it long, right? My risk is going to be 2 or 3 points, and I could get a potential 13, 14, 15 point rally on my hands. Really, really good risk to reward. Then the market essentially just consolidates and just moves sideways like 30 minutes after I enter. Similar to all my trades earlier that I took long, Monday, Tuesday, market breaks under this low. And I was stuck in a weird spot, right? So keep in mind, my original stop loss was under the low a day at these 94s. So I'm in at the 97s, stop under the 94s, risking 3 points. However, the market broke under the low, right? And this is the double caveat to all of this, is if I stopped out, I would have looked for a re-entry, meaning the market breaks under the low, right? So essentially, just to give you a heads up of what I did, is I added to my position. Now, I don't like adding to losing trades, but I'm going to tell you why I did this. The market breaks under the low, right? And I was ready to stop out of this trade. However, we break under the low around 11:14-ish, right? So I'm going to fast forward to 11:14. And as we are breaking under the low, right, here's the low of daybreak, right? You can see it breaking under that low. There's a bid down here getting filled. So I'm still in this trade, right? Technically, my stop loss hit. However, I'm seeing this and I'm like, all right, Carmine, if I stop out here, I'm probably just going to re-enter in 10 seconds or 30 seconds. So instead of me stopping out, I added to my position, right? If I didn't get confirmation here, I would not have added to this position. But because I saw even better confirmation, I was like, okay, if I was out of this, I would be entering right here. But since I'm still in this and not stopping out, I don't see a reason why I should stop out. Instead, I should just add to this position because I'm confident now that this is better confirmation that the market is going to rally up. So we could see here a bid getting filled, and that's what exactly happens. The market rallies up, and because I added, it lowered my average, and we get a strong rally up, and I exit all out of this trade above the high of day. 53.06. So the market breaks the high, we break it, and then I exit all out of this trade at 53.06, and I scaled out along the way. And this was a $10,000 profit. So yeah, good exit at the high, good scale at 53.01, because look what happened after. The market absolutely dumped, and I didn't really have a short plan, and this thing just kept selling off and selling off. So yeah, it was a profitable 5-figure trade, but I can't really look at it like that because yeah, I sold at the highest price, but it was really only 7 points on the S&P. If it wasn't for me doubling down, it would have been only a $5,000 profit, or maybe even like a $3,000 profit, and it would barely put me green on the week. Then we sell off, and then Friday we get a really strong rally. Had some really good trades here, but was hesitant to pull the trigger. Just didn't really see confirmations on Friday, and that was pretty much my week. So the best advice that I could give is brush off any mistakes that you make. If you're struggling, if you're failing to, find consistency, but you have a solid strategy and a solid system, just keep at it. Like, don't give up on it. Don't throw in the towel. Like, my edge and my strategy is there because it's what works for me. Yeah, I might take losing trades. Yeah, I might get in my own head. But if I focus on the present moment and focus on setups that I know work out for me, I know in the end result is that if I manage my risk and have winning trades, it's just going to make me money in the long run. So that's my best advice. Never put your head down. If you struggled last week, let me know in the comments below. If you enjoyed this video, you got a lesson out of it, drop a like, subscribe to the channel, and comment any questions. Peace.